So tell us a little about your portfolio. Why so few names?
So for a bunch of reasons. I mean, I've always had the view that, why not own the best 10 or 11 investments as opposed to ideas 12 through 25 or 12 through 100, which is more typical. And, I think there are very few great investments at any one time. So the ability to concentrate is an enormously valuable asset of a strategy. The problem with it is it leads to bumpier returns. And it leads to more attention on mistakes or things that aren't going well. I don't know a portfolio manager that doesn't have a stock that's down in his portfolio, right? But you don't read articles about. We're getting an awful lot of attention for a pretty high-profile situation that's struggling. But I think there's. It depends on what your business model is. But if you want to make high rates of return over a long period of time, it's hard to do that being very diversified. I mean, if you look through the Forbes 400 wealthiest people in the world, most of them made their fortune in one business or a portfolio of two businesses. Very few made it in a portfolio of 100. So it's that. And the other benefit, it allows you to run a much simpler investment firm. We have an 8-person investment team. If we had 30 names, we couldn't manage that portfolio the way we do with a small team. By having a small team, you can hire better talent.
There's actually an argument that some people are now making that, buying the index or buying diversified funds have had much better returns than buying, those hedge funds that have, a very specific smaller portfolio approach like yours.
I haven't seen that article. I mean, I think we've done very well relative to any index alternative, certainly. So, it depends on how you judge us. I think if you judge us on a 90-day basis, I have no idea how we're going to do relative to an index. But I think this is a strategy that over time should earn a meaningful premium over, any kind of benchmark, or you shouldn't give us your money.
Yeah. And usually this investment philosophy, does it take a week, a month, 3 months to do the research, a year? I mean, you have 10 names. How long?
It depends. I mean, one of the best investments we ever made, it took us 4 hours to do the work. It was during the financial crisis.
Which was that?
Wachovia Corporation. Okay. So I was on my BlackBerry eating breakfast at the Brooklyn Diner in front of my building, and there was a story went across the I was just, Wall Street Journal headline, a Reuters headline, excuse me, went across saying that Citigroup to acquire the Wachovia banking subsidiaries for $2 in Citigroup stock. Stock was halted. And this was kind of an interesting transaction because they were buying the subsidiaries for Citigroup stock. I figured, that's interesting. What happens to the holding company? So I went back to, kind of went upstairs to the office and, cracked open the 10K and another member of the team, Mick McGuire, he and I worked on it. And what was interesting is the 1,000-page 10K of Wachovia Corporation, I think 900 pages were on the banking subsidiary. There was fewer than 100 pages on the holding company. And by buying the banking subsidiary, Citi was leaving a holding company which had cash, in Wachovia Securities, A.G. Edwards, they had paid $6-7 billion for it 6 months before, Evergreen Asset Management, and they were taking a $27 billion loss on the sale of the subsidiary. And it also had a liability called non-cumulative perpetual preferred stock, which if you ever want to have a liability in your life, this is the single greatest liability to have. It's a form of equity where you never have to pay a dividend. And when you don't pay them, they don't accumulate. And the worst case is they get a couple of directors on the board. And you say hi to them each meeting. And you have this I said, look, this could be our Berkshire Hathaway. And at the end of the day, we figured in 4 hours, we determined the holding company was worth at least $11 to $14 cash, a tax refund that you could carry back the $27 billion loss, recover cash taxes that have been paid. So you have this cash vehicle. You own Wachovia Securities, which is a good wealth management business. Mm-hmm. You own A.G. Edwards, another interesting asset. These are businesses you know well. And the stock opened after it was halted at $1.84. So we said, look, it's worth 11 to 14, $1.84. We bought 42% of the volume for the next 4 days.
What would you say is the mistake you made in hindsight and that you would try to avoid in the future?
Sure. So
there's sort of 8 principles that have driven our investment success. And when we have veered from those 8 principles, we've lost money. And after the 2000, we went through a very difficult period, circa 2015, 2016. The 2 investments you mentioned were big drivers of that. It was if you will, experiences making mistakes and learning from them. And it was a moment of reflection for the firm. And I went back to the core principles that have driven our success for the first 12 years. And I had a member of the investment team literally engrave them in a stone tablet, not dissimilar from Moses' 10 Commandments. And I had that stone tablet put in what you might call a deal toy, sits on everyone's desk in the office. And we've adhered to those principles, ever since. And, we've been fortunate to return to the success we had for the first dozen years. So I think it's about keeping to our principles are basically, we want to invest in simple, predictable, free cash flow generative, dominant companies with large barriers to entry that earn high returns on capital, that have limited exposure to extrinsic risk we can't control, strong balance sheets, don't need access to capital to survive, have excellent management and good governance. Sounds logical, but occasionally we've diverged, and there's those times. There's a certain discipline that comes with investments, and there always seems to be a countervailing quality that caused us to diverge. But in really each case where we've compromised on business quality or complexity, we've been harmed from an investment standpoint.
The next president of the United States would be Donald Trump. He's going to be reelected. You know for certain. Would you short the market? Would you go long the market? What would you do?
It really wouldn't change anything that we're doing. Our strategy is to buy super high quality, dominant companies that can withstand a pandemic or a dramatic movement in interest rates that are not particularly exposed to the economy. So, who the president is, it's not something that we would make a bet one way or another on the portfolio. I started as an investor. I raised the first pool of capital when I was 26. And I made an early investment in a company called Rockefeller Center Properties. And I saw management making a series of decisions that made no sense to me. It was just so obvious the right thing to do as to how to create value. And it was being a frustrated passive investor that made me into an active investor. And, that investment turned into a very profitable and very high profile investment. And with success, one is motivated to try it again. And it's been helpful to the strategy over a very long period of time, and it's fun. And if you're passive, you can feel like the market's patsy, and if you're active, you can actually create some value. And I think it's a lot more interesting than just picking securities. We bought a stake in Chipotle at a time where the company was struggling a few years ago. We put a few directors on the board. We recruited a new CEO named Brian Niccol. It's completely turned around the company. The stock has, almost tripled in the midst of a crisis. And it just tells you that, that's a lot more fun and it's a lot more profitable. And it's, I would say, a lot more good for America than just simply being a passive stock picker.
Can you explain that, why the market seems to be so much higher than the economy is?
Sure. So, when people talk about the market, they talk about either the Dow or the S&P 500. And the S&P 500 is a market cap weighted index. And what's interesting or fortunate and unfortunate about the crisis is it affects different companies differently. And the more dominant large cap, companies, the stronger the balance sheet, the stronger the market position. Those businesses are huge beneficiaries of the crisis. And what the market does not reflect are small businesses, private companies, more levered businesses that don't have access to capital, don't have the same dominance as the public market. So a business like Amazon, which is a very big component of the market, is up 45%. That does a lot, obviously, for the averages. It's probably something approaching almost 10% of the S&P index today. My guess is 6-7 percentage points of the index. Businesses like Google, Facebook, I think long-term beneficiaries. And ultimately, the value of a business is the present value of the cash it generates over its life. And even if the cash flows are disrupted in the short term, if they're greater in the long term, the values will be higher. So I think the stock market is a snapshot of a portion of the economy. If you had an index of smaller businesses, the market would be down 50, 60, 70, 80%.
What's the general investment style, and why did you set it up that way?
So the vast majority of capital invested in the markets today is passive. So if you think of index funds or ETFs or even the big kind of long-only institutions, the vast majority of that capital is by charter passive. Passive means you do your research, or in some cases you don't do the research. You sort of just blindly follow an index and you're judged based on how closely you follow the index. If you think about investing 100 years ago, though, you had Andrew Carnegie owning 20% of U.S. Steel, or you had J.P. Morgan as a large owner of various companies over time. And in the old days of investing, an owner would act like an owner. So if they were unhappy with the performance of the business, they would replace the CEO. If they were unhappy with the board's judgment, they would make changes to the board. And as capitalism sort of democratized the investment process, and as any kid in business school can open a brokerage account, and as the owners of many of these great businesses over time, gave the shares away to a university or their heirs, and the ownership was spread out. The Sam Waltons of the world kind of passed away, and the boards became to be managed by professional owners. And so what we do is we look for situations where a business has lost its way, where an otherwise great company in a business that we would define as one that has significant barriers to entry, that Warren Buffett would describe as having a moat around it, a business that is simple, predictable, generates cash, and we can be confident will be here 50 years from now. A good example is we own a stake in Canadian Pacific, which is a railroad in Canada. And if you think about the railroad business, it's a business where they're not going to build a new one across the street. You can have, absent some fairly dramatic changes in technology, you can be pretty comfortable that goods will be shipped on rail for a very long time to come. So it's a business we can predict. We can think about it from a very long-term perspective. We can buy it at a price that's interesting. And in the case of CP, this was the worst-run railroad in North America. It had the lowest profit margins. It was trading at the lowest valuation relative to earnings, and had a very unhappy shareholder base, but there was nothing they could do about it because they were inherently, again, the biggest investors tend to be very passive. And we saw an opportunity, and the opportunity was if you could replace the worst CEO in the railroad industry with the best CEO in the railroad industry, a lot of money could be made. And we bought first 12% of the stock and then another 2%, so about 14% of the stock. We recruited a guy named Hunter Harrison, who is widely considered the best railroad executive of all time, certainly in North America. He had retired at 65. He was 66 and a half. He had signed a 2-year non-compete with his employer, and I think the biggest mistake they made was a 2-year non-compete because he was running the other Canadian railroad, Canadian National. And we hired him as a consultant. He helped us study the railroad, and he had plenty of fire in his belly. And we said, look, would you be interested in a day job? And he said, let me check with my wife. She said, you know what, it's time to get you out of the house again. And
my wife says that all the time.
And we recruited him, and then we had to simply put him in place. Now, the problem was Canadian Pacific has one of the most sort of esteemed and illustrious boards in Canada, at least at the time. And it was the former head of the Royal Bank of Canada, the former CEO of Suncor Energy, the former head of the steel business. It was a very, very important board. And they didn't like the idea that this idea was coming from outside the company, so they said no. So we went to the shareholders and we ran an election, a proxy contest. We put up 7 directors for 7 seats on a 13-seat board. And the shareholders voted with us 90% of the time and voted against the other guys. And they got between 3 and 11% of the vote. We put our directors on. We did a review of the best CEOs in the world. Turns out the guy we identified was the best guy. We put him in as CEO. That was 16 months ago. And it's almost the most profitable railroad in North America after 16 months. That's how quick this guy goes to work. Stock's gone from $46 to $151 a share. It's, a little under $8 billion market cap to a $25 billion market cap. And that's kind of the perfect example. Now, it doesn't always work that way. And I have a feeling that Peter might ask me about one of those cases.
So I used to cold call Bill as a student, so this is going to be fun. So it's very clear you've had notable successes. Bill's own estimation is 23, 2, and 1. Is that, do I get the numbers right?
24, 2, and 1.
24, 2, and 1. 24 wins, 2 not wins, 1 tie, something like that. And Canadian Pacific is clearly a win. I think you just monetized $800 million. That's what I read in the papers.
We sold about $1 billion of stock.
And then MBIA is another one where Bill was prescient about the fact that the financial markets were going to, well, that MBIA, which is a large insurance bond insurer, was in for a bad ride, and you figured that out. But there are some, the 2 and 1, where I think what you've said in some of your recent things, where you've had some things that you've learned from those experiences. They might include, for example, JCPenney, that's been in the news this summer. So what have you learned from the successes, and then maybe what have you learned from the ones that haven't been successes?
Again, as I said at the beginning, experience is making mistakes and learning from mistakes. And unfortunately, as students, you haven't made many mistakes yet. If you've gotten to Oxford at this point in your career, the biggest risk is you probably haven't screwed up a lot. And so, the risk of that is when data comes across your desk that's inconsistent with your being successful, you're less likely to pay attention to it than if you've made a few mistakes. So I encourage you to make some mistakes. Actually, I've made plenty over the course of my career, and I think I've been very successful over time, but it's not been a straight line up. In fact, if I were a stock, it would look something like this after business school, and then, so the concern is whether this is coming, But so far, we've the overall trend has generally been positive, but there are certainly bumps along the way. And JCPenney is a company that we invested in that we knew on the way in was a much higher risk situation than a Canadian Pacific. So JCPenney, for those of you who are not familiar, is a 112-year-old American sort of iconic retailer that's certainly way past its prime. It probably peaked 25 or 30 years ago. Again, another example, you had James Cash Penney, who founded the company. He died, I think, in the early 70s. And there's a pretty good correlation between when the founder goes and when the company goes. And part of that has to do with governance, which is a topic I'm sure we'll get to. But the time we invested, JCPenney stock was down from $80 to about $20 a share. It was trading at about 4 times operating income. It had lots of assets lying around in the company that were non-core assets. It had a very bloated expense base. And it was generating very little sales per square foot. It was a very underachieving retailer. And part of that is the brand had become somewhat tired, and they had gone to a very highly discount-oriented model where they'd mark a dress at $40, and they wouldn't sell any at that price. And a week later, they'd mark it to $20, and they probably wouldn't sell many at that price. And then they would send you a coupon where you got $10 off, and then you start to sell a few. And then if you used your credit card, you got $4 off, and if you bought this moment, you get another $5 off. And eventually, it was $8 or whatever, and they sold a lot of them at that price. And but this was undifferentiated merchandise. And the thesis was this company has actually still a brand, well, faded, restorable. And because they were created over the last 112 years, they actually own about 112 million square feet of some of the best real estate in the shopping mall, in the shopping malls, in the shopping real estate industry. They own or have very long-term leaseholds at very low rents. And we said, look, this is a great platform to rebuild the company. And we bought a 16% stake in the company. I was invited to join the board. I joined the board with a friend who bought 10% along with us, so we owned together 26% of the company. We both joined the board. We were 2 of 11 directors. And the CEO was 64, and the board was very much focused on succession, as any board should be generally, but particularly when their CEO is in his mid-60s. And we helped the board with succession, and there was a candidate that kept surfacing as the best guy in retail. And this guy's name is Ron Johnson, and he had an ideal background. He didn't go to the Oxford Business School, but he went to Harvard Business School. And he graduated, he went to work for Mervyn's. His dream in life was to reinvent the department store. And Mervyn's was kind of a dying department store. It was acquired by Target. So he spent a few years at Mervyn's. He spent 10 or 11 years at Target, which is probably the best run U.S. discount department store. And then he was hired by Steve Jobs to build the Apple store from a blank sheet of paper. And he did an absolutely incredible job. And we said, look, you couldn't ask for a better background to do what we're trying to do here. Reinvent the department store. Combine the Apple customer store experience with kind of some of the Target brand excellence and cost management. And the problem was recruiting him. He's very happy living in Atherton, California. He had $400 million of restricted stock in Apple, $100 million of which he was going to lose if he left. And he had kids who were 13, 15 years old, in the middle of their, at a time when parents don't like to move. But I managed to convince him to take the job. And he walked away from $100 million in restricted stock. We gave him $50 million to make up for it, but he still took a loss when he took the job. And then he invested $50 million in 7-year options that he bought with his own money that he couldn't sell for 6 years. So I thought this is the absolute perfect thing. We have the best guy. We've got a great platform at a really cheap price. We have the perfect alignment of incentives. And I thought, it's done.
But it didn't work.
But it didn't work. And so Ron got started in November of 2011. And he proceeded to make a series of changes, many of them very favorable. Among them, he took a very hard look at the cost structure and found about $1 billion that he could take out of the cost structure of the business. We took a hard look at all the non-core assets, and we monetized about $600 million of the non-core assets. So far, so good. And then he launched a business plan to convert the JCPenney store into basically a mini shopping mall, a Selfridges type model where there were a series of brands, each of which would have their own kind of presence in the store. And then you'd have a consolidated checkout, with a wireless experience and sort of this Apple-like customer service experience. And he sold this idea to brands that heretofore wouldn't be willing to go into JCPenney. And the guy's very charismatic. It was a great idea. And he had a whole bunch of brands that he got from around the world who were excited about opening up inside JCPenney. And he went to work. But he made one very significant strategic mistake. This whole notion of what he almost called fraudulent pricing, this overpricing an item and then marking it down and coupons. He said, look, this is a waste of time. Let's just market at the price. The consumer knows the fair price. Because when you looked at those $40 dresses and $40 shirts, they all sold it for something like $12.30 on average, and very little sold at any other price. He said, let's just market at $12. The consumer understands value. We can save a huge amount of, the company had spent an enormous amount of man hours actually changing signs. If you think about how often they're constantly repricing and reticketing and changing signs, it made the stores look really cluttered. And, it sounded like a brilliant idea. And the Apple experience was not about testing. So instead of trying this out in 1 or 2 stores or in a region, he rolled it out across the country. And it failed. And the customer who had become accustomed to getting coupons in their Sunday circular, all of a sudden the coupons weren't there, and so they decided not to come. And we lost about 1/3 of our customers after about 12 months. And the great thing about a retail business, if you get it right, is this business has enormous operating leverage, right? Because you've got a substantial fixed cost base, but once you start generating additional sales, it almost all drops to a lot of it drops to the bottom line. Well, only a problem with leverage, as you learn in business schools, it works in reverse. And so all of a sudden the company was losing huge amounts of money after having spent a ton of money on capital, rebuilding and redesigning these stores. And we found ourselves in a turnaround 15 months after he was hired. And we had to replace him.
And the lesson?
There are many. So number one, this was what I call an extreme makeover of a company. And when you do an extreme makeover, it requires perfect board alignment and backing for the CEO. And we didn't have that. Number one, we were one of 11 directors on the board. And there was still had it worked perfectly from the beginning, there wouldn't have been a problem. As things got dicier, there was a divergence of opinion on the board of what to do and when to do it and who to hire. So I think that's one interesting lesson. I don't think I'll ever go on a board and be one of 11 anymore. I like going on with a mandate like in Canadian Pacific. Two, I think Ron is an incredible talent, but I don't think, like the students in the room, he'd ever made a mistake before. And I think it was, as the data kept coming back, Ron still had a lot of confidence it was going to work. And you've got to back your CEO and give him rope. And I think Ron will be, and I think he'd say this today, he'll be a much better CEO the next time because having had a big negative experience like this. I think third, retail is one of the businesses where you can really test, right? You can take a region, you can take a store, and you can try things out and rejigger them and test them. And I think, the Apple experience, Steve Jobs was all about the customer doesn't know what he or she wants. I know what the customer wants. And Steve Jobs, got it right. I think in retail, there's a kind of a saying, the customer knows what he or she wants. And I think you really have to listen to that. So while I still love the vision for JCPenney, I think it was right. I think the execution was difficult. To do something like that, and also in the public domain, right? This is a major change, and the company was constantly being harassed by the press, and Ron was attacked. I think it makes it difficult to make decisions in that kind of a public context.